And I'm here to say events are going to come again. They're going to drive gold higher. Remember, with every controlled demolition, some things have to go up for other things to go down. And the interesting thing about this is probably a dollar weakness element, because I'm also expecting Bitcoin to trickle up. I'm expecting silver to go up, and I'm expecting platinum to go up. So let's see. And this is a dollar weakness, as I say, and potentially a reaffirmation of the yen. And there's more to be said on that. But the yen is kind of the wholesale funding system that sustains America on the carry trade. I think it's far deeper than people are telling you. It's not just a bunch of hedge funds that have been using carry trade funding. I think it goes far deeper and could go right into state. But anyway, who knows?
The dollar has slumped more than 10% this year, posting its worst decline in the first 6 months of a year since 1973, back when President Nixon shocked the world by detaching the dollar's value from gold. Gold prices have shown a strong bull run over the last decade, with a 10-year return of 12.16% compound annual growth rate. Long-term investors have made a significant profit despite gold often experiencing prolonged periods of stagnancy. The recent performance of gold has been particularly impressive, with a year-to-date gain of 27% and a 40% increase in the last 12 months. Technical analyst, trader, and macroeconomic strategist FrancisHunt links gold's strength to ongoing dollar weakness and is also bullish on Bitcoin, silver, and platinum. He points to the yen carry trade as a key support for the dollar. Hunt suggests its deeper geopolitical role is often overlooked. From a macro view, Hunt recalls his 2011 prediction of gold reaching $3,000, which materialized with strong gains. Hunt notes that gold's price action is compressing, signaling a possible breakout. He identifies 3 distinct sell-offs followed by relief rallies, leading into the current upward move. Gold's historical performance over various timeframes highlights its resilience and potential for strong returns. However, gold's performance has not been without challenges. Between 2011 and 2020, gold returns were negative, indicating periods of market volatility and uncertainty. While reflecting on fundamentals, Hunt expects a possible gold pullback to around $3,250, suggesting it as a buy zone with stops just below and a target of $3,700. He sees an 8-to-1 risk-reward trade setup. He warns against overconfidence during wins and stresses disciplined risk management. Gold prices are under pressure amid hopes for potential trade deals that could reduce demand for the safe haven metal. While the trade war between the United States and other nations is center stage, several other factors will also continue to influence gold prices in the future. Before we dive into FrancisHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
This is gold and dollar, and we know the dollar's been weak for an extended period. Don't forget the HVF that we gave on this channel with you, Danny, when it was 2011. We said this is an upside move. Don't close at target. Hold at least 50% for a far larger move to the 3,000 range. You might recall that call. That was an over 50% return that was delivered on overperformance on gold. Since this level when we touched 3.5, and we literally just kissed 3.5, and I talk about key levels of significance. Once you've done 3,000, the next key level is 3.5. You literally kiss it, and then you had quite an aggressive sell-off. You saw that spill, you saw this spill. It rallied because there were late buyers coming in. It rallied, and then you had a further spill, and it made almost that a new low post the 3.5, which is in and around 3,100. I'll just give you the number, 3,120. And that was your massive up move, your make of the key level of significance at 3.5, which is the logical round number. By the way, the next one is 3,750, and I'll come back to that in a minute, because you're sitting between 3.5 and 4. So you think about that, and we're going to be giving you targets through the 3,700, which is probably going to lead to that 3,750 run. Then after that, what did you do? You had a slow grinding climb. So there were a few burnt hands, maybe some of the hot money that had got high liquidity long got a little bit of a flush out here. There was a gap, for example, certainly on this broker, which is Tickmill. It's one of ours that we use. By the way, you can trade from inside your trading view chart. Anyway, up, down, a bit grinding. And you can see we drew a dotted red line, which is where we expected it to break. And you could see there was quite a bit of grind there. This was the commencement. and then you came down and you would have a break again. So again, a bit of a relief. That was 3,450. So it's law of round numbers. Remember how we talk about this to you because of futures, 3,500, 3,450, secondary high. Makes sense to me. Does it to you? Key levels of significance. It's called pegging, and it's derivatives, round numbers. They often dictate these things. Down, what level did you just run? 3,250. Again, makes sense to me. Secondary low, higher than the previous one. So we are actually getting a constriction in terms of the volatility. This is what we're always looking for. Squeezy, squeezy, Japanesey. That's what you're getting. And then you've had a bit of a rally from the 3,250, but also a pullback. You'll see there's a pullback going down, 3,282, a just run of the 3,300. Now we've had a rally. Now, often these sells come in threes, three distinct moves, sell moves. For example, you had this and then you skidded. That's a sell move. That would be a sell move. That would be a sell move. That's you into your low. So you think of it as one sell, rally, two sell, rally, and then three sell. That's a five move, you know, an A, B, C, D, E. I've stopped counting now. I think it ends in F. You get a little bit of that quite often in terms of sell-offs. It often happens like that. And if you look on the smaller time frame here, you had a sell-off move, a rally, sell-off move, a rally, and a sell-off move. So again, three distinct sells, 2 and 3. And now we're having a rally. I think you've made a higher high here. And I think any sell-off, this looks a little toppy. So I think gold going into Friday, I'll be traveling on Friday, still can come off one more time. So that means never chase in at market. The best traders determine a level and trade to a level and say, if you're going to sell off, come down to here and fill me there. My stop would be there. Now, there is a possibility you could match or even just run this low. So the safest stop for me would be below the 3,250 and try box accumulate. So remember, we invest, but we also trade. I'm discussing a medium-term trade where you could set a buy limit order where your stop would be placed and where your potential target would be. So, you know, I think buy limits, let's do it in a different color. Go for the little boy blue. And I think buy limits in that range would be very profitable, stops under there, and then trade through the 3,700, possibly keep a bit over for an overperformance to the 3,750, which should be around there. 3,750, just below that 3,760 up top there. And that would be a very, very beneficial trade for those. And I typically turn precious metals trading profits into actual investment. So take at least half. Don't sit with a flush trading account. It's dangerous. People get cocky. They get overconfident. It's psychological warfare. You think you really got it now. You want to just rinse, repeat, and you want to go bigger this time, and you got a bigger account to do it more. And this is your millionaire or your billionaire or your centimillionaire trade. You know, all the usual demons that undo retail traders. In the absence of method, you will get washed out. So this is not a recommendation. This is the kind of thing we do, that we're talking about, what we think will happen. So people should bear that in mind. But if I just put a risk reward on that, it could be quite beneficial. A long position, let's put it roughly in the midpoint of that box. If you could buy in there, you stop out there. Remember, it can fail. You have to price for failure. In terms of your trading, you should always price for failure. So that's around an 8 RRR. And that's pretty attractive and be quite a nice trade for me on the gold. And the interesting thing about this is probably a dollar weakness element, because I'm also expecting Bitcoin to trickle up. I'm expecting silver to go up, and I'm expecting platinum to go up. So let's see. And this is a dollar weakness, as I say, and potentially a reaffirmation of the yen. And there's more to be said on that. But the yen is kind of the wholesale funding system that sustains America on the carry trade. I think it's far deeper than people are telling you. It's not just a bunch of hedge funds that have been using carry trade funding. I think it goes far deeper and could go right into state. But anyway, who knows?
Regarding the silver market, FrancisHunt highlights a bullish setup following 2 HVF windups and a recent breakout. He sees potential for a move toward the $50 resistance zone. This area is historically thin and, if broken, could trigger a major long-term rally. On July 11, 2025, silver prices surged by $1.35 per ounce. This notable jump cleared the long-standing resistance at $37. A classic bull flag pattern led to this decisive move. Such formations typically indicate a predictable follow-through in price movements. Silver is currently outperforming gold in this cycle. This divergence signals growing interest in the precious metals sector. Moreover, traditional leadership by gold is now being challenged as silver increasingly captures investor attention. In his analysis, Hunt particularly underscores an upside forming in gold, silver, and platinum, despite growing public fatigue on the topic. He highlights the UK's worsening debt crisis, noting welfare cuts are planned while military and migration spending remains untouched. A wealth tax is triggering a millionaire exodus, signaling deeper systemic mismanagement. Let's get back to the interview.
Let's talk about silver, though. People want to hear about this. We've kind of got a setup there that sort of broke and then had a pullback. It had a pullback. We had a Sunday open real strong, and the Sunday open on thin volume ran into a bit of Mr. Slammy action. But all that's done is you get a rebound and you've wound up again. So we've got another wind up, and now we are walking, and we just technically broke that one. Now, last time we had two, what we call HVS winds up, and then you had a super overperformance surge. And we've now gone and done the same thing. This target is at 38.28. I will show you the previous time this happened. It wasn't that long ago. Here it was. And again, you got this kind of structure. So it's almost a fractalization of what's happened before. You might see this. There you go. Squeeze. It broke. That's kind of the traditional entry that we would have had. And then it wound up. Again, it needed to wind up again. But then instead of doing a normal move, it did a number of overperformance move, and silver really did well. Don't forget, we were down here. We traded at 31.7. 31.7. That was some time ago. We went up, 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 pull it all through, walk it all back, walk it all back. You can see how far down we came from 31.7, and the next thing you knew, you're at 37. Which in dollars is quite a substantial move for silver. And now we have a little bit of samification, if we can say that, fractalization of a similar nature, basically, and a wind up here, which is kind of interesting. So I think you could actually, once you get that compression twice, it's really building up that sort of centrifugal force to be let go. So it could overperform in this side, but we'd look at 38.28 so far as the next leg up. After that, you on the bigger time frames, you're talking about the $45 to $50 range becoming the next major critical range. You're in pretty thin air historically for silver. So let's just give you some long range chart reminders of years gone by. If we were to get to 38, which is very borderline the 40 area here, you're talking about super thin air. Apart from that little localized high at about 44, which to me is the 45 to 50 range. Once you run that, we're in that 45-50 golden demilitarized band zone that eventually we will break. However, I would anticipate that there would be quite a bit of chop and resistance there. Again, that's Mr. Slammy zone. But this move up to 38 is bringing us a lot closer to that demilitarized zone, that dead man's zone. And once you're above that, well, then, you've been unshackled. Then it's a concept. And many people say, classic technical analysis will call that very clean cup and handle. And for us, it would be an ascending HVF structure that generates better targets. It's even better framing for the same price behavior. We would call that, and we'd get targets out of it. And as I've done before, I've done this on CPI, but there's big numbers that come out of this upside projection. Very big indeed. I think that's technically a tiny bit higher than that one. I don't like.
Why do they want the millionaires in Dubai? Is that
it's part of a controlled demolition? They're actually moving talent, skill, and capital. This is happening across the world, and it's the UK of the first world Western nations seems to be at the apex of migration out. And there's still some millionaires that will go, often from China and Canada, for example, to the US. So the US numbers is less one-sided than the UK. But a lot of that money is going to be, if it's Chinese, it will be to support Chinese business, and it'll be like a local office guy who's helping the production back in China. So you never leave China, even if you're not in China, if you know what I mean. That's how communist states work. It's a bit like never leaving Israel, even when you're in New York. You know where your home is. So, but the UK doesn't have any of that. It's like all rats abandoned ship at the moment. Certainly the rich ones, and they're going to go rodents out in plastic millionaire land there in the desert with the highest building. You should always follow the highest building indicator. By the way, it's almost like a passive Freemasonry special handshake sign. Wherever they build the highest building is the place of next point of ambition and capital formation and everything else. I'll also point out Southeast Asia is still going to be the production workshop and where stuff gets made, and it's going to go up in living standards immensely. And Singapore is going to be the acceptable face of capital formation, probably more so than Dubai, Tel Aviv, or anywhere in the UAE. But a lot of people are going to relocate for tech. They won't have laws that'll stop them from putting chips in brains and awkward things like that. I want to remind people that when the CIA, ergo the Mossad, wanted to torture people, they did unofficial flights to the Arab nations where they could do that rather than face breaking laws in their homeland. But anyway, that interesting little opening gambit is the UK are telling you who they're going to attack, quite specifically in the nature of that headline. And it's the promises, or they called it the array of promises, this massive buffet we've laid on for you. Meanwhile, all the other expenditure items you can be assured will continue and will be continuing to find. So the debt-based collapse is ongoing, and we remind people to remember that. And I think the rates going up are the hardest. Next is going to be, we're going to be looking at the UK, particularly at that, and they might jump in front of the queue even with US. And be pushing up higher numbers sooner. We've already had a scare on Japan, and of course the original scare in 2020 was the US with a better part of 55% devaluation. So that's our framing, and that's the petroleum juice for the rocket that is gold.
Across extended investment periods, gold preserves its purchasing power, outpacing inflation and diversifying an investment portfolio due to its historical tendency to have a negative correlation with other asset classes. Favorable fundamentals could position gold for further gains through late 2025 and into 2026. In such a scenario, increasing exposure to gold remains a smart strategy. As gold continues to defy skepticism and climb higher, is your portfolio aligned with the metal's long-term momentum? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.